Joining me now, Jake Schurmeier, Portfolio Manager, Head of Fixed Income, Currencies, and Commodities, Multi-Asset Solutions Team at Harbor Capital Advisors. Jake, thanks so much for joining us.
Thanks for having me, Caroline.
All right, so I think given your title, there's a lot to hit here, and I think portfolio construction is a good place to start. Does 60-40 still work in this environment, or do investors need to consider a different playbook?
Yeah, I mean, I think generally it still does. You know, you still have your exposure to growth, kind of the U.S. economy, kind of the long-term prospects of equity. So, you need to keep that ballast. You know, fixed income is the part that's a little challenged going forward. We're going to have higher inflation over the next year, and we expect it to be higher and more volatile going forward. And so in that environment, you need something that diversifies a bit more, whether that's commodities, whether that's kind of market neutral strategies, other kind of true alternatives that can diversify for those environments where inflation is very high.
So on that note, when you look across equities, bonds, currencies, commodities, what's really driving your investment decisions right now?
Yeah. We think commodities look the most attractive to us right now. So gold's a big portion of that. You know, you're making a play against kind of the weaker dollar, kind of concerns about U.S. institutions, inflation. And then more broadly, there's this secular kind of demand for commodities going forward, whether it's building out AI data centers, whether it's electrification, EVs, all of those things are going to take a lot more copper, aluminum, silver, all of these things to conduct electricity, to build concrete, to build steel, things like that. So we think there's a secular demand for commodities going forward as well.
Okay, so on that note, you mentioned the fact that gold is at record highs right now. Mm-hmm. Is it too late to get into gold, or what commodities actually look attractive to you right now?
We don't think it's too late. So, on a real inflation-adjusted basis, we're kind of at all-time highs, but there's reasons for that. We've had the U.S.-led institutions for the last 80 years, and those are unraveling in many different ways, whether that's tariffs, whether it's kind of decisions around NATO, things like that. And so in that environment, you're just going to have more geopolitical volatility, more inflation volatility, and you want something that, has a 6,000-year track record of protecting against that.
Do you have a price target for gold?
No, we don't.
And in terms of using it or other commodities as a hedge against inflation, how much of that is driving your investment decisions in terms of even putting commodities in your portfolio?
We think that's a big part of it. Inflation risk, not only to be higher, but just more volatile going forward. And so there's just going to be more volatility across, broader assets. So that's a big portion of it. But we do think dollar weakness, kind of this institutional, anti-institutional play, we think that's a big part of the commodity story as well.
Okay, so we can put the check mark next to commodities. Let's shift to fixed income and where you're finding opportunities there. You mentioned it's a bit tougher of an environment.
Yeah, so the curve's obviously been steepening for the last few weeks. We're thinking about Fed cuts. They're likely to cut 25 basis points tomorrow, some dissents in favor of 50 basis points. But obviously there's some politics around that. It's pretty fraught going forward. And so we do think the curve steepener still has a little bit more room to run here as people kind of price in more inflation risk. But, we think credit, spreads are very tight. But, in an environment where growth is slowing, but not slow, you're going to be fine kind of clipping that carry and continuing to have some equity beta in there.
So the 40% of the portfolio and the kind of generalized portfolio should be in what?
We're thinking like 30%, 32%. And so you're going to want to have high quality. We like MBS in favor instead of kind of treasuries for that core kind of AAA rated exposure. We still like EM debt. We think you can kind of play the weaker dollar that way. So that's another thing where we have an overweight, call it 4 or 5% of that basket. And then the bulk of it's going to be, IG credit by and large.
So if investors want to protect their portfolio using things like bonds and treasuries, what should they avoid?
Yeah, if you're worried about inflation, you want to be shorter on the curve. So you want to avoid duration. Tips we think are pretty attractive. Kind of market implied inflation is, 2.5% when you kind of look further out. We think there's clear upside risk to that. So tips are another area where you can get some of that inflation protection.
Okay, so put the check mark next to fixed income. And then, of course, we want to focus on growth. Where are you finding growth opportunities right now? Because we've seen this huge move higher in, of course, big tech. Do you expect that to continue, or are you finding growth in other areas?
Yeah, I mean, the AI trends, Oracle last week were, pretty phenomenal earnings. And so there's clearly a secular boom going on. I think you have to probably start getting a little more selective. NVIDIA is kind of treading water here. while other companies are thinking about, less, making their own chips, diversifying across their chip stack. So we still think there's some value in the enablers, whether that's on the energy side, turbines, things like that. But I think you just have to be a little more selective because, valuations are quite rich there, but the secular trend is still intact.
Dig into what it means to be more selective, because I'm sure there are investors out there that are worried about buying at the top, right?
Yeah.
So how do you balance, innovation with also discipline?
Yeah, I mean, it's, quality growth. It's so, that GARPy exposure, you want to think growth at a reasonable price. You want to think more about that. And so, active management, that's something we believe deeply in. And so you want to find managers who've had kind of a long-term track record in finding and uncovering these opportunities, especially when valuations are as rich as they are for many of the kind of large cap, highest concentration names.
So final advice for investors who want a diversified portfolio, that, a balance of growth, but also protection to the downside, because we do know that the market doesn't only go higher, even though lately it's been in this uptrend.
I think it's to just be open to the idea that the next 10 years could be very different from the last decade. Granted, the last decade was pretty extreme. We had the highest inflation in 40 years. We had a pandemic. Hopefully we don't see either of those in the rest of our lifetimes. But just be open to the idea that, international could come storming back if the dollar continues to weaken. Be open to kind of commodities being on a secular kind of bull run akin to what we saw in the 2000s. Be open to the idea that AI is going to move beyond the chip names, the infrastructure names, to software, other enablers, and the kind of real economy as we think about it.
All right, we'll leave it there. Jake, really appreciate your insights. Thanks so much.
Thank you so much.
That's Jake Schurmeier, Portfolio Manager, Head of Fixed Income, Currencies, and Commodities, Multi-Asset Solutions Team at Harbor Capital Advisors.